Okay, there are some widely used ratios that everybody who's anybody understands. Yeah, we're going to highlight 6 here that are quite common. They'll come up in business conversation, particularly financial statement conversation, all the time. These are ratios that are quick to compute, easy to understand, and easy to use to tell a lot about a company and how it relates over time and how it relates to competitors at the same point in time. Those 6 common ratios are the debt ratio. It tells us something about a company's leverage. Return on sales tells us something about a company's profitability. Return on equity tells us a little bit about how an investor does relative to his or her investment in a company. Current ratio tells us a little bit about liquidity as well. Asset turnover tells us something about efficiency. And the price earnings ratio is a unique ratio. It uses a market measure, compares that to an accounting measure to tell us what the market thinks about the future growth prospects of this company. We're going to use these 6 ratios. We're going to get familiar with these 6 ratios. We're going to use this data to do it. Got an example here, 2 years for this company, and then I picked a competitor as well so that we could do comparisons. 2 years for the example company, 1 year, same point in time for the competitor. This is the data we're going to use to introduce these 6 commonly, widely used financial statements. Here's the first ratio. It's called the debt ratio. It's a measure of leverage. Basically what it's saying is, of the assets that we have, of the assets that a company has, how much of those assets are financed by borrowing, either from suppliers, from banks, from bond markets? How much of our assets are financed through liabilities? In other words, how much of those assets are we going to have to pay back? What percentage of our assets is funded by creditors? The reverse of that is what percentage of our assets are funded by owners. So we take, to calculate the debt ratio, it's pretty easy. We take total liabilities. We divide it by total assets. We get a percentage. Here's a quick example. Using, again, our data, we get in X8, their debt ratio is 0.73, which means 73% of our assets are funded by liabilities. In X9, that had gone down just a touch to 0.72. And we say, okay, well, it's fairly constant, 0.73, 0.72. How does it compare to its competitors? And when we look at that, we see that its competitor is 0.66. So we compare 0.72 to 0.66, and we ask the question, which is quite common with financial statement analysis, why? Why is our competitor at 0.66 and why are we at 0.72? And which one is better? What we've got to be able to say is, we're at 0.72 because, and then list our reasons. Or our competitor is at 0.66 because, and then list those reasons. But we note the difference, then we have to ask the big question, why? Why is there a difference? You know, if we're doing the same thing our competitor is doing, we should look like them, they should look like us when it comes to financial statements. And when we look different, we should ask the why question. In this case, we're fairly constant over time, 0.73, 0.72, but we need to drill down and say, why are we different than our competitor? Are they too low? Are we too high? Why?